Hi, this is Mike Swanson. I'm speaking with David Skrika. I'm visiting Dave in his place in the Bahamas on Luther Island. And the last time I came down here to visit with you, it was the very end of September. And we did a video in this exact same spot. And we were remarking at that time of a huge breakdown that was going on in the internals of the stock market, meaning that although the market averages looked okay at the moment, the stocks inside the S&P 500 and the NASDAQ and the Dow as a whole were just declining, and gold was getting smashed, oil was starting to get smashed. And we did the video saying that we were on the edge of a violent correction that would probably be some sort of precursor to a bear market. And that correction indeed took place, and then the market, of course, rebounded, made new highs in November, and we had a little drop in December, and now we're doing this video the very end of March, and we see all the NASDAQ go above 5,000 for like 3 hours a few weeks ago, and then the other week it got above 5,000 for 3 full days, and it's since come back off that level. So we're seeing kind of like volatility in the markets. And what do you think this all represents at this time?
Well, see, the thing is, actually, one of the best interviews I saw was one with a guy named Phil Fuckenstein. He's kind of a famous bear, and he made money in the 2000 and 2007 bear markets, and then shut down his short fund in 2009. And he talked about the 2007 period. And in March, what happened was all the it's funny, a lot of the first-time mortgage payments started to default, the resets. Because what happened in the financial crisis is people were able to get these upfront loaded mortgages that were nothing upfront, and then the payments and the principal would really kick in, say, after a year. So the first time when the payments and the principals really rose, there was a huge amount of defaults in March of 2007, right? So the thing about it is, in March of 2007, Bill said, okay, this is it. The mortgage defaults are starting. I'm going to short the market. This is what I'm getting into right now. And then what happened, though, the market reversed. He said he lost about 15 to 20%. He had to cover his short positions, regroup, and then, of course, he started shorting later that year with the top. And that's kind of my experience with October of last year. As I really thought last year was going to be the start of the bear market. And when you were here in September, right, we saw the market begin to erode, technically, right? So we saw the stocks above moving averages go down. We saw the advanced decline line go down, all this sort of thing. And, of course, that led to the first real correction we've seen in about 3 years into October of last year. But that increasingly just looks like the March correction of 2007 or something similar.
Yeah.
So that was kind of like the first warning. And then we rallied back up to new highs. We're still seeing the internals kind of lag on this rally in terms of the number of stocks over the 200-day, 50-day moving average, that sort of thing. Okay? So, we've seen all this sort of thing. And now the question is, where do we go to here? So the question is this March peak here the peak, or are we going to see maybe another decline and then another move higher or whatever? I think the problem with the market moving significantly higher from here is this. The internals are declining, like I just mentioned, and then you look at these leadership stocks. You're looking at the Microsofts, the Intels.
Well, they've all been shot.
Yeah,
they're acting very poorly. Even Apple is.
Yeah, Apple has started to roll over a little bit. So we're just laughing. There's my cat. She wants to be the star of the video. You can look at her butt there. Come on, go, right? And I'm gimping around because I have a bum ankle right now. But anyhow, Apple's and these stocks have all kind of rolled over, but especially Microsoft and Intel. And if you look at the last move of the NASDAQ, it was really just, number one, the biotechs, right? And number two, Apple. It was really, and maybe a couple other smaller internet stocks or something like that, but it was really those two parts of the sectors. And the biotechs looked like on the recent quadruple witching day, like they blew off. that they had a big gap up and they reversed that day on huge volume, and they came down quite hard this past week that you were here visiting. So it looks like to me that again we're seeing this massive kind of topping formation, and the question is, do we see one more move higher into the summer, or is this kind of the top? Now I'm under the belief that when we get into April here, because of the high dollar is going to hurt some corporate profits, because stock buybacks stop, in the quiet periods for these companies, you're going to see a good size correction. And the question is it just like the correction of like last December or last October, or is it actually like a 10 to 15% correction, and then does a rally fail and then we really, really roll over?
Well, I think a big problem with the stock market is it's in a very vulnerable position. Whereas the moving averages, the long-term 150 and 200-day moving averages are starting to kind of flatten out. In these rallies that have taken place, each time the market has made a new high, it's gone up for a less amount of a gain and a fewer, less amount of time. So in November when the market made a new high, it went up for a couple weeks. In February when it made a new high, it only went up for like 2 weeks, and now it just goes up for a few days. And the way I think of the market is not to just set aside the question of what's going to happen next week or next month. Is I think that we are in a stage 3 topping market, and it really began in January, and what we saw in October was the continuation of that. And I think that's what we're really in. We have the internal deterioration, the bullish sentiment, which has gotten even more bullish now, and there's no one bearish on the market according to investors' intelligence at all. But the final real bear market will start when we have a bad drop, like you're saying, 15% would do it, and then you're through the moving averages and you get a terrible rally and it's just over with. And I think that's what we're heading to, whether that's starting now or in a few months or whatever. But I think the most important thing people really need to do is not just sit here and just think, oh, it doesn't matter, it hasn't happened yet, or these people on TV are bullish or whatever, but really to start preparing for this. And I think that's really the most important thing. Isn't so much to actually figure out what's going to happen next week, but to really be prepared, because once this starts to happen, everything is going to change in the markets, and the way people have been making money will no longer work. But more importantly, there will be better opportunities to do stuff, and cycles will be shifting and all sorts of things. And you just got to really be on. This is one of the years that you really get to be on top of stuff.
There's some interesting coincidences too. Like if you go look at the 2007 top, actually the market topped in October 2007, which happened to be exactly 5 years of the bottom in 2002. And what's kind of interesting about this, if that March top was our top, is that we've topped in March of 2015, which just happens to be 6 years to the bottom. And then obviously also 15 years to the top of the last NASDAQ top in 2000. So there's these kind of weird seasonal patterns playing out too, where actually if that was the top, these last two markets have topped exactly, to the month of the last bottom.
Well, the bottom of the S&P in 2009 was at 666, so why not 6 years later?
Why not? 6666. Yeah, good numbers too, by the way. And actually, in another video that we're going to do, we're going to talk about that, because this is really interesting aspect of psychology, is that we did a conference. I'm going to just leave it at that, but just the way people think now compared to the way people thought at that conference, which we did in March of 2000, was is really interesting.
The March 2009.
Yeah, March 2009. It's just really interesting. So we're just going to leave that because I want to talk about that more in the next video.
Okay.
But anyhow, yeah. In terms of that, yeah. The thing about bear markets is, see, what makes this one I think unique, and all markets repeat cycles and top, is that with the amount of intervention we've had from central banks, people just don't think that that these markets can even go down anymore. Right? Like what they think is that if the market goes down 15 or 20%, like 2011, for example, the Fed's just going to come in and print more money and pump up the market again. So I think even though we don't have the boom in the economy like the late 90s, and we don't have the mass public participation, in a lot of ways, we had a boom in the housing market in 2006, 2005, people that are actually in the market right now are way more exuberant than they've ever been, because they feel that there's this Fed put that they can never lose money. which I think actually makes this really, really dangerous.
Well, one thing about the people that are in the market now and very bullish on the market is in 2000, there was the internet bubble, and you did have a lot of new people get into the stock market that lost a lot of money, as a result of the bubble, and that's why they got in it. And I was actually, you could say I was one of these people that got in because of the internet boom in a certain sense. But the thing about it is, when these people lost their money, they kind of accepted that. They understood that this was kind of really just crazy and so forth. And it wasn't really a big shocker to people, I don't think, what happened. In 2007, the market crashed, and a lot of people got out then for good and never got back in. And some people just had to sell because they needed the money, they're retired or whatever. Other people lost their jobs, needed the money financially. And all these different reasons, people just did not get back in, or a lot of people did not get back in. But the people now, for the most part, seem to be people who didn't sell in the last bear market and are now convinced that that was the right decision to make, so they will never sell again, with the assumption that, well, the Fed made it go up that time, they'll do it again, and they are kind of like married to their stocks and just convinced that.
Well, I think too, there's actually a great saying that you don't mix a bull market with brains, right? And I've been there in the gold market, or any stock market, that when you got a market, especially like this one, that has gone straight up, right? And my cat wants to be the star again. It gone straight up, and for a number of years, and the thing about this bull market too is, forget the biotechs, they're not really that widely owned by the public. But we've talked about this. You look at stocks like Kroger or Disney or Nike. These are big blue chip stocks.
Microsoft, Intel, IBM.
They all went straight up for the Philip Morris, or it's Altria, but they all went straight up for the last 2 or 3 years. So, and those are widely owned. So it's made people feel like they're really smart because they own these stocks that have gone straight up. And you're fond of calling this bull market the stairway to heaven, right? Which I've actually used a lot now when I talk about it. And you got this 2-3 year cycle where the market's gone straight up with no pullback, and it's very abnormal for markets to trade like that. And I've actually talked about it. There's only about 5 times in history that has happened.
When was that?
26 to 29, which of course that's the great crash. 34 to 37, which to me is the most similar to now, because it was a Fed-induced, kind of government-induced, like stimulus kind of bull market, right? Low interest rates coming off a big crisis, that sort of thing, right? 52 to 56, which ended in the 56 bear market. 62 to 65, which started the secular bear market, and 84 to 87. Those are really the only times it kind of traded like that, and somewhat 95 to 98. So, and that led, there was a Russian crisis and a pretty severe correction in 98. So really, those 5-6 times are about the only time. And my point is, every single one of those times ended in a bear market, right, after the 3rd or 4th year. And the only one that wasn't a severe bear market was 56. And every other one, even though 66 was only a 25% bear market, adjusted for inflation, it was a lot more. And that was the beginning of the big secular bear market in stocks that lasted 16 years. So I just gave you your history lesson. 87 was the crash, 37 was a 50% decline, 29 was the great crash, which was 90%. So it's like every time you get the market trading like this, it ends in a disaster. And again, when you look at these stocks like KR, like Disney, it's abnormal. This is not how markets or stocks trade. Yeah.
She's out of the view now. Yeah. Well, one of the things about the market is that the myth, I believe it's a myth, or will be proven to be one, that the Fed can just make it go up forever, and that's what people believe. In a drop in October, when that was going on, there was a leak to Steve Leisman that the Fed would do QE if the market continued to decline. And then a few days later, there's some Fed official saying something like that too. And then the market rallies and people believe it. But the thing is, the last 2 bear markets in 2000 and 2007, the Fed lowered interest rates dramatically, especially the 2007 one in 2008. They lowered rates like 3 points 2 or 3 times. I mean, that's very dramatic. And in low interest rates, when they lowered those rates in those 2 bear markets, it did have a stimulative effect on the economy. I mean, for goodness sakes, the first bear market from 2000 2003, by lowering rates to as much as they did, they helped create the real estate boom.
Yeah.
And this time they don't have the ability to stimulate the economy by lowering rates when the next bear market comes, and the QE does not have the stimulating effects on the economy. We see that the economy has not been stimulated by this QE crap, and people think, well, it'll just make the stock market go up. Well, the problem is people said that when they lowered rates, and it took years of lowering rates to make the stock market bear market end. So how much QE would need to be printed to force the market higher? Nobody knows, and it could be that it would be so harmful by creating more inflation or something that it's just a crazy idea to begin with, that you just print money to make it go up. Very reckless, to even want that to happen.
Yeah, and when you look at this bill, see what happened, like you said, when the last kind of zero, there's been 2 0 rate cycles now, because rates got down like 1%, like in 2003 or so, and this time we're at 0, and there's quantitative easing and all this sort of thing, right? So that one, you're right, what stimulated that time was the housing bubble, right? And then this time what it is, it's like a financial bubble in terms of stock buybacks, in terms of this sort of thing, right? So that's really what's happened today, right? And so it's just basically an equity market bubble. And what the ironic thing about this kind of equity market bubble is there's really like no revenue growth right now in these companies or whatever, and there's no real growth. But actually, with the combination of 0 rates, cheap money to buy back stock, and little to no wage pressure because the economy itself is not good, that's actually a better scenario for these equities than, say, if the economy was booming. Because the economy booming, okay, you'd have top-line growth, but the thing is you'd also have to pay people higher wages, and interest rates would be higher, so you couldn't buy back and borrow all this cheap money. So this is like the perfect scenario for equities. But of course, we both think it's a bubble and going to end. Like, I don't think this can last like that much longer at this point. I think that it's really, really got to end. So this is a financial engineering bubble. That's what I would call it, right? So, and I think it's just going to end in complete. Like I'm not a doom and gloom type, but the last year I've never been as bearish as I had. Like, I think this is going to be a complete and utter disaster. And again, we'll talk about this in the other video we're going to do. We're going to talk about more philosophical stuff. But I think it's almost like the people in the system involved with that, people own those large cap stocks, these big companies that are buying back stock. What I think is that they're almost succumbing now to this greed, and they're going to crush themselves under this greed, because bull markets end in greed anyhow, right? So in maximum optimism. But anyhow, that's all I'm trying to say, is that you got like a dot-com bubble, a housing bubble, and I would almost consider this like a Fed/financial engineering bubble.
And of course, the biggest bubble is the bond market, which interestingly enough, in the past, and historically, bonds in times of stock market bear markets go up, or as a safe haven. And now the bonds are in a bubble, so they'll probably go into bear market along with the stock market. And of course, so far this year, they've actually been trading together when the market's dropping, and then terms of going down, which is really kind of alarming. You look at this scenario where like a third of the world's bonds or quarter of the world's bonds have negative yields. It's like the polar opposite of 1981 when we had 15-20% yields on treasuries, and it's like this is like the blow off of the top. Now no one knows how high a blow off can go. Did it peak a few months ago when most bond yields bottomed in January, or did it is it going to have one more leg higher? We don't know, but this is like the ninth inning of the bond market, bull market. And what's funny about it, you just look at the basic common sense, go look at the debt to GDP of all these Western countries, from Italy to Spain to the United States. Every single one of them has seen a huge boom in the debt to GDP in the last, since the financial crisis, but the yields have plummeted. So it makes no sense. Like, the higher debt means higher risk, right? So why would the yields plummet? And I know it's done it in Japan for 25 years, but there's a lot of different dynamics that going on there. But anyhow, it's just funny that really these government bonds are getting more risky and risky as these governments become more indebted. But at the same time, people are pushing yields lower and lower. And I think at some point there's an end game to that. I just don't know when. Well, I'd like to add, as we wrap up, one other thought. And we've both been doing this for a long time, and we've seen 2 bear markets before, and I can just say, from reading emails in the past and so forth, it seemed like in the last 2 bear markets, what people tend to do is feel trapped. Like they're afraid, they think they have 2 choices. One is to stay fully invested and hope things go up, and they're told that's the right thing to actually do on television because the second choice is so terrible, and that is to do nothing and go in total cash and sit there and you can miss out and these, so forth, and no one wants you to do that, and anyway. But I really don't think those are the 2 choices people have, because there's a whole world of things to trade and invest in. You can trade against the market too. You can short stocks and make money. And there's other things that will eventually go up, or maybe starting to go up. So I actually see this not as a time to be scared, like, oh, all I can do is sell, and I'm just at a position I can make giant mistakes, which is how people like on TV can be presented. But instead to think, this is actually a great opportunity, because imagine if you could turn back the clock to 2007 and know what was to come over the next couple of years, there would be an incredible opportunity. But if you understand market cycles and how things play out, that's essentially what we have in front of us, I believe, is when market cycles shift, they only happen every couple of years, but if you take advantage of it, it sets you up for a very long time.
Yeah. Well, the thing too, just the last thing to note about cycles and bear markets is, I want one because I will actually, like, one of the 2 of the only markets I've bought in the last few years have been Greece, especially in 2012, and Russia last year, December. And the reason being is those are 2 of the only markets in the world that actually have value right now. Like Russia has a higher dividend yield than PDE. And that's what I want to buy. And the problem with all this financial engineering is you can't find value. You can't find cheap stocks, These people think because some stock trades at 12 times forward earnings with hyper financial engineered earnings, it's cheap, but it's not, So that's why I embrace a bear market coming, because I'll actually be able to find stuff that's cheap. And for example, one of my best stock picks ever, and I'm not just saying this to beat my chest, this is where I learned this is where you have to invest like this, was in 2009. I bought Tata Motors, that Indian car company, and I sold out last year, and it went up tenfold. It went from $350 to $35, and that was because I actually was able to buy at a cheap price at the 2009 bottom, So we're actually watching my cat chase her tail, which is actually what people are going to be doing in the bear market.
Look at that.
I'm going to save this one. See, I'm going to do the new one. See, so the new one